Hey, everybody. Thanks so much for joining me. Before we get started talking about SoFi's earnings, please take a minute to click subscribe to my channel if you don't already. And please check out the link you see on your screen right now for a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So, we recently learned about SoFi's first quarter results, and on the surface, things look pretty good. The banking sector hasn't exactly been doing well lately, especially smaller banks. There's worry about deposits like fleeing institutions, things like that. That's not a problem with SoFi. The deposit base was up 37% sequentially. Now, this isn't a fair comparison to most other regional banks. SoFi only got its banking charter in early 2022, so it essentially started from zero 5 quarters ago. So that sequential growth isn't quite as impressive as it sounds, but it's still very encouraging to see that people are still putting money into that account or in their SoFi accounts. Beyond that, the membership base rose 46% year over year, despite kind of the challenging environment in the financial sector. 5.66 million members. The number of banking products also rose by 46%. The strongest growth is in financial services products, being the bank accounts, the credit card, and the brokerage accounts. SoFi's revenue and adjusted EBITDA were record highs for the eighth consecutive quarter. I mentioned the deposit base was up 37% year over year and now covers 62% of their loan portfolio. It's the goal of banks to be able to cover their loans, their lending activities with low cost deposits as opposed to having to borrow money elsewhere. It's usually a big cost advantage. So as that percentage creeps up, which it has over the past 5 quarters since SoFi has been a bank, it creates more of a cost advantage. SoFi said it's benefited from its rolling out $2 billion of FDIC insurance for its customers. And the bank beat its expectations on the top and bottom line from analysts and also beat the high end of its own earnings guidance. So, the $1 million question, the stock is down 20% since earnings. Why is that? So, there are a couple of reasons. One, the Galileo platform, which SoFi said it wants to kind of build into the AWS or Amazon Web Service of finance, lost account holder or reduced its number of accounts for the first time ever. It was a little bit expected, but still something that investors don't like to see. And most importantly, the big concern is the loans held for sale. Of more than $16 billion of loans on SoFi's portfolio, most of them, over 90, something like 98% of them, are designated as loans that are held for sale. This is not a great environment to have a portfolio of personal loans and things like that that you're trying to get rid of. So it's a big concern that SoFi won't be able to unload its loan portfolio if it wants to. It didn't make any major loan sales in the first quarter, so that I think that kind of is causing a little bit of investor concern. But I think it's kind of overblown. SoFi's portfolio has stronger credit quality than most. The median FICO score in its portfolio is 749, meaning that its average customer has well above average credit, and has relatively short duration risk, meaning less interest rate sensitivity. We saw in the Silicon Valley Bank collapse, one of the big reasons is the loans that they had for sale, or the securities they had for sale, were long-term treasuries that paid very low interest rates, and as a result of interest rates rising fast, were worth a lot less than the bank paid for it. SoFi's loan portfolio, some of it might be worth less than its original principal balance or the original, based on the original interest rate, but not as much, not enough to cause a big concern about the bank's health or anything like that. So looking ahead, SoFi had said last quarter that it will be profitable by the end of this year on a GAAP basis, on a net income basis. The higher cost of capital is hurting a little bit. SoFi pays high interest rates on its deposits. That's how it's been able to attract so many deposits. It's a lot of the reason, and that's hurting its cost of capital a little bit. Um, But on the other hand, it's starting to create a lot more marketing efficiencies. One of its biggest weaknesses was its customer acquisition cost. I don't know if you're a SoFi customer, but the bank has been offering incentives such as like $300 if you refer a loan customer that gets approved, $50 if you refer someone who opens up a SoFi checking account, even if they only put $10 in. So high acquisition cost. As that customer base builds up, It's a more natural marketing funnel for loans. In other words, it's cheaper for the bank to market loan products to customers that are already in its ecosystem than try to bring new loan customers from elsewhere. Only 1 in 4 SoFi members currently has a loan with the company. So that's a big opportunity to cross sell products as customers' financial needs evolve. So, a big unanswered question right now is the student loan business. SoFi is still making student loan refinancings and private student loans. About $5 billion of that $16 billion loan portfolio is student loans, and about $500 million were originated in this past quarter. So it's not a dead business, but for that part of the business to really take off again, SoFi needs student loans to come back. The federal student loan moratorium has been going on for over 3 years now. It's set to expire at the end of August. Um, and forgive me for not being totally convinced that everyone's going to start making student loan payments again at the end of this year. So, will student loans restart? That's a big unanswered question. If they do, that's a big positive catalyst for SoFi's refinancing business. But as of now, SoFi is calling for 27 to 31% revenue growth this year. That's a significant slowdown from 2022, but still very impressive considering the environment. It's calling for margins, adjusted EBITDA margins rising from 9% last year to 14% this year. Big part of how it's going to achieve profitability by the fourth quarter. And like I said, with the stock 20 down 20% since earnings, this feels like a big knee-jerk reaction based on the general turmoil in the financial sector. It doesn't feel like SoFi's numbers justify that much of a crash. I can totally understand investors being skeptical, especially since almost 100% of its loan portfolio is labeled held for sale. It's not a great time to be trying to sell a loan portfolio. But having said that, this company is doing everything right. It continues to beat even its own expectations quarter after quarter after quarter. If it actually achieves profitability later this year, an opportunity like this to get in on the stock at below its book value with these kind of growth numbers could prove to be a steal for long-term investors. Now, I'm not offering personal financial advice, but SoFi is a big holding in my portfolio, one that I've added to several times, and I'm going if this the price right now holds, I'm going to add to it even more, and it's one that I think could be worth a whole lot more in the years ahead. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.